every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Friday the 6th of October. We're rejoicing, it's the end of the week. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. You can contact me on Substack at peterlewismoneytalk.substack.com or on Facebook, where my page is Peter Lewis Money Talk, or on Twitter, which I'm still struggling to call X, at Money Talk R3. Thank you for listening and for making Money Talk one of the most downloaded financial podcasts in Hong Kong. In today's business and finance headlines, Kristalina Georgieva, head of the International Monetary Fund, said the odds of a soft landing for the global economy have risen. Speaking ahead of the annual World Bank and IMF meetings in Marrakesh, Ms. Georgieva said the remarkable resilience of the global economy this year has cut the chances of a painful recession in the coming quarter, and she highlighted strong momentum in the US economy and also singled out India as a bright spot. And in India, growth in the Indian services sector has beaten estimates. The S&P Global India Services PMI increased to 61 in September from 60.1 in August, signalling a sharp upturn in outputs that was one of the strongest in over 13 years. New business increased by the second fastest since 2010, with export order growth being one of the fastest seen since 2014, and business sentiment improved to an over 9-year high. Hong Kong's private sector has contracted for a third month. The S&P Global Hong Kong PMI fell slightly to 49.6 in September from 49.8 in August, remaining below the 50 mark that separates expansion from contraction for a third straight month, and signalling a continued deterioration in the private sector conditions. Weaker demand conditions, including foreign demand, led to reduced output and further pessimism among private sector firms in Hong Kong. Alibaba has been accused of possible espionage at its European hub. The Financial Times reported yesterday that Belgian intelligence services have been monitoring Alibaba's main logistics hub in Europe over concerns of potential espionage. Referring to the company's logistics arm at the cargo airport in the city of Liège, the security services said they were working to detect possible espionage or interference activities by Chinese entities, including Alibaba. On today's programme, I'm joined by Francis Lun, the CEO of Securities, and Kenny Wen, Head of Investment Strategy at KGI Asia. With us later in the show is Tony Nash, founder of Complete Intelligence.
Peter Lewis's Money Talk.
On Wall Street, US stocks rallied into the close, reducing earlier losses. Ahead of crucial jobs data later today, the S&P 500 slipped 0.1% to 4,258, recovering from losses of 0.9% earlier in the session, and the broad-based index is on track for its fifth straight week of losses. The Dow fell 10 points, that's under 0.1%, to close at 33,120. The Nasdaq Composite traded down 0.1% to end at 13,220. Later today, economists believe non-farm payrolls for September will show a 170,000 increase, down from 187,000 jobs gain in August. US Treasury yields across the curve have retreated from their highest levels in over a decade. Earlier this week, the yield on the 10-year note hit a new 16-year high of 4.85%. It ended yesterday's session unchanged at 4.72%. The 30-year US yield reached more than 5% for the first time since 2007, before the financial crisis. On Thursday, it closed out the session slightly lower at 4.89%. The US dollar index was 0.4% weaker on Wednesday, trading around 106.35. The Japanese yen remained below the politically sensitive 150 level after breaching it for the first time in nearly a year on Tuesday. Yesterday, the Japanese currency strengthened 0.4% to 148.44. Oil prices resumed their slide yesterday after recording their biggest daily decline in more than a year in the previous session. Brent crude fell 2% to $84.07 a barrel, having dropped more than 5% on Wednesday. And shares in Hong Kong snapped 2 days of losses that had seen the Hang Seng Index lose almost 3.5% over that period to hit an 11-month low. The city's benchmark index rose 18 points, or 0.1%, to 17,214. The index was up 0.8% at the high of the day. The tech index closed 0.1% higher Mainland markets still closed for the Golden Week holiday, but they do reopen on Monday. Here in Hong Kong, futures markets pointing to a jump of about 110 points for the Hang Seng at the open. That's 0.6%. The index should start somewhere around 17,321. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Looks like it could be another wet and windy weekend. So to cheer us up, we have with us in the studio Francis Lun, the CEO of KGI Securities. Morning, Francis.
Hi, good morning.
And also with us, the ever-cheerful Kenny Wen, Head of Investment Strategy at KGI Asia. Morning to you, Kenny.
Good morning.
I want to start talking about the markets, because it's been a bit of a dramatic week, hasn't it, this week, particularly in the Treasury bond markets. Yields, as you heard earlier, across the curve, reached their highest levels in over a decade. Francis, the 10-year bond yield, it's risen 60 basis points in just 1 week. This is not normal behaviour, is it, for the bond markets?
Yeah, that was really extremely volatile, and I think it is something like a 20-year high or something like that.
16.
16-year high.
Yes.
Yeah, and 30-year mortgage in the U.S. now is 7.49%, and which is high enough to discourage people in buying new home now, because they can afford the down payment. They can afford to pay the mortgage. That's the problem. And in Hong Kong, the same problem, because interest rates are so high that some people have problem paying the mortgages, and that's why the housing market is so down. And everybody's clamoring to ease the restrictions, please.
Kenny, why is this happening? Why are we seeing this big move upwards in bond yields? All around the world, actually, isn't it? But probably being led by the US.
Yes, I think it's driven by 2 weeks ago, the Federal Reserve meeting referred to the dot plot chart. You can see that now the market expects the interest rate will rise one more time this year, and especially for the rate cut. Originally, everyone expect at least 3 to 4 times rate cut next year, but according to the dot plot, now maybe just 2 times. So, what we call higher for longer is now the market expectation. That's the reason to push up the bond yield. But I think for the 4.8 percentage point for the 10 years Treasury yield may be somehow already reflected the latest market forecast. The further upside potential may not be too significant, but anyway, I must say that the market do have another opinion. This morning, I read the report from JP Morgan. They expected that the federal fund, the Treasury yield may rise to 6%. So,
wow.
Even though this is not our base case scenario, but in case this happen, it will hurt U.S. economy, U.S. stock, as well as Hong Kong. But I think that even though we said it is now the 16 years high for the Treasury yield, but it just back to the period before 2008. So I think for the past 15 years is an abnormal zero interest rate environment. We now just back to the normal situation, and everyone, including investor, need to adopt that the relatively high interest rate will appear in a foreseeable future. So whenever we make any investment decision or financial decision, we need to take into account a relatively high investment environment situation.
Changes everything, this, doesn't it? Do you know what Barclays said would be the only thing that stops yields rising in a report they've just issued? They said a stock market crash.
Or a recession?
The Hong Kong market already crashed.
Exactly.
Well, that's true. That's true. Do you know, I said this on the show yesterday. I've seen this before. And do you know what this reminds me of? You may remember, Francis, 1987 was when this happened last time. And over the summer of 1987, bond yields in the US started to rise very, very fast. And then there was also a lot of turmoil in the currency markets over that summer as well. And then we know how that ended with the stock market crash of 1987. And as I said on the show yesterday, I can see similarities between what's happening now in the markets and 1987. So I don't want to worry you, because history doesn't necessarily repeat itself. But Francis, do Do you remember that time?
Yeah, definitely. I remember very vividly because on that day, actually, the Chinese tycoons are forming a syndicate to buy Hong Kong land from the Jardines Group. And Robert bought something like 500 index futures, which resulted in a $1 billion loss.
In 1987.
Painful. And that was a lot of money then.
That's right. And then the market crashed and it stopped trading for 4 days. And then when it reopened, the market fell 1,900 points in one day.
Well, Hong Kong does have this reputation of when there is a market crash or big market moves, it always seems to do worse than everyone else.
Yeah, definitely. But this time it's different because the Hong Kong market is already at a very low level. It's 17,000. How much lower can you get? Not much.
We might find out soon.
Yeah,
I think exactly, because many people ask me that October is a very poor month. Always some sell-off happen in October. But I think that now it's already 17,000. We already have a crash. So how much can we? The downside may be relatively limited. But so I think. In terms of fundamentals, now talking about the forward PE is 8 to 9 times. I'm not saying that because we do have some fundamental core issue need to handle, for example, Chinese economy, Chinese property market, but the downside is unless there's something crash happen in US, otherwise I do think that the downside risk may not be as large as other investors think.
But if yields carry on rising and they go to 6%, as some analysts are now saying, what sort of impact is that going to have on equity investors here in Hong Kong?
That will be terrible. But look at one key indicator is the price of crude oil. It actually crashed this week.
Yes.
Well, that's another odd thing, isn't it? What's going on in the oil markets as well?
I think people are look at the numbers. People are predicting a sharp drop in the demand for oil. Globally, the demand for electric cars has risen dramatically. And in China, more than 30% of the new car registrations are electric cars, and it is showing a rising trend. In Europe and the US, because Chinese electric vehicles are flooding the market worldwide.
So this is going to be another this is all linked ultimately, though, to yields, isn't it? In the bond markets,
right.
That's where it all emanates from, sort of ultimately. In this new environment, then, because we've got to get used now to interest rates being at these sort of levels, aren't they? Because they're not going to go back to where they were a couple of years ago. Do we have to focus more on debt, both private debt, corporate debt, government debt? Does this become now a much bigger issue?
Yeah, frankly speaking, in the early this year, when we believe that the stock market will be very volatile, we do recommend investment grade bond because we suggest investors to lock in a relatively high interest rate, and then when the U.S. government to cut rate maybe next year, you can enjoy a mild capital gain from the bond market. So seems to be a quite attractive investment. But as now the interest rate will be higher and longer, frankly speaking, those invest on bonds, they do suffer recently. But we think, but the reality is that for the past few weeks, stock market and bonds market also suffer. So diversification is not working again this year.
Well, normal correlations have broken down, haven't they? The way asset classes normally tend to move either together or in opposition to each other. It doesn't seem to be working at the moment, does it? So we did see a bit of this last year when stocks and bonds both came down together as people started to think there was going to be a recession, but then there wasn't. Although now maybe, I'm wondering, actually now, are the recession risks going up because of what's happening in the markets?
Well, not according to Georgieva, the head of IMF, and she just said that the the U.S. economy is showing remarkable resilience, and despite the UAW strike against the big three auto workers, and hiring actually increased in the U.S. And Ford just reported strong sales and production. It doesn't seem the strike is hurting the big three very seriously right now. So I think U.S. economy will carry the world through this, so-called downturn right now. I think the stock market is in the correction mood. It's down from the year high. I think maybe it will fall a little bit more, but not that much, not to the 30,000 level. I don't see it for Dow Jones falling to 30,000.
We are not bearish on U.S. stock, but for global or U.S. economy, we remain that the recession is only delayed but not avoided, because soft landing is very, very hard to achieve, because if the economy is very strong or resilient, you need to keep going wait. But until when you stop to wait the rate, then usually the economy or already get hurt and under recession. So the optimal point is too difficult to achieve. So we will not be too optimistic. The U.S. and the global economy can really having the soft landing scenario.
But that IMF report, the trouble with the IMF is they're always backward looking, aren't they? They're saying the US economy is more resilient. Yes, it was over the last 9 months.
Yeah.
But at the beginning of the year, the IMF was quite gloomy, saying that the chances of recession was high. And I'm wondering now if they've missed the boat again, because yes, it was resilient over the last 9 months, but are things for the next quarter, the next 6 months, going to change? Because you've got interest rates at levels that make it very hard for consumers. You know, they're not going to borrow at these sort of levels, take out loans. There's signs of stress in corporate debt markets, because companies have got to roll over their debts now at much higher levels. So I'm wondering if actually maybe the recession might be coming later on this year or early next year.
Agree.
It could, but right now we have not seen any signs of it. But I know one borrower is really hurting is the U.S. federal government. Is paying something like $1 trillion US dollars a year in interest. Now it's a big percentage of the annual budget. They cannot afford.
So have they got to cut back? I mean, is the debt in the US is going to become an issue, isn't it? Because of just their interest expense at the moment.
Well, according to the right wing of the Republican Party, you have to cut your expenses 23% across the board.
Now, how much is that going to be a factor as well? Because we're heading for another government shutdown, aren't we, in the US?
In 40 days.
November 17th.
I think, you have insane people in the Republican Party. I don't know. You have to live from crisis to crisis every month in the
I worry
US.
that because U.S. will have the presidential election next year, so politically it's getting complicated in the coming 6 months. So get prepared. Not only the relatively high yield, not only the still remain the recession risk, but the political risk will also drive the stock market quite volatile in the near future.
And why is the jobs market so influential in all of this? Because we're seeing some of the biggest moves in the bond markets on the back of a jobs report. We had the JOLTS survey earlier on in this week, didn't we? The job opening survey, which was much better than expected. So yields shot up. Then we had the ADP private payrolls report, which was worse than expected. Yes. So the yields all came back down. Now everyone's waiting for the official non-farm payrolls report later today. So presumably, if it's better than expected, yields are going to shoot up again. And vice versa.
Yeah, but the problem is the numbers do not tell a coherent story, and nobody seems to know whether jobs are the unemployment rate is going up or down, and everybody assumed that the economy is still keep on growing. If that is the case, the yields will go up again. And that is bad news for stock markets.
It's really difficult to forecast the number because, first of all, the jobs data is quite volatile. And also, if you really focus on the data, they will revise upward or downward later. So, for today, the announcement may drive the yield or stock market, but don't be too optimistic or pessimistic because somehow they will revise later.
And what should I read into what's going on with the yield curve? You remember back in the summer, it was heavily inverted over a minus 100 basis points. I think it got to about minus 110 basis points. Well, it's now steepening and we're down to about minus 30 basis points. So in other words, it's getting less inverted. The yield curve is steepening now. What's that telling us?
Well, they're telling us that the future is not as bad as predicted, because early in the year everybody's predicting a recession, almost 90% certainty.
Yeah.
Now, recession is not in, so I think long-term yields are going up and short-term yields are coming down. So you have the narrowing of the inverted yield curve.
But one thing is very interesting. Yes, the inverted yield curve become less inward is a point to a relatively good economic situation. But if we focus on the stock market, it's very interesting that for the past 20 or 30 years, when the inverted yield curve become less inverted or become normal, then usually the stock market sell-off will happen. That's very, very interesting. So seems that is happening now.
So my 1987 comparison might be coming true then.
Better not.
So let's look at Hong Kong then.
Yeah.
What are people supposed to do here? Because every time, we have a big sell-off, we get a rally. People hope that maybe that's the bottom, but the rally just doesn't seem to last very long, does it? It fizzles out very quickly. So this week we've seen the Hang Seng lose 3.5% in just 2 days. We had an 18-point rally yesterday, which is pretty miserable, really, in the grand scheme of things.
Rally.
Isn't it?
You can forget it.
What are we supposed to do here?
Well, I think pessimism just pervades the stock market for the entire year. Ever since February, the market has been going down non-stop. The problem is the lack of money. Nobody seems to be buying. Yesterday's turnover was only $47 billion. Yes. It's like a morning half day trading. So we have to get people interested in buying stocks. But in order to get people buying stocks, the stock market has to rise.
It's a vicious circle.
If the stock market doesn't rise, nobody will buy.
It's a vicious circle.
Yeah.
If we focus on the trading volume, I think somehow we can say that the selling pressure is not so large. That is good, but we are lacking any positive factors. So most investor will take a wait and see approach. So I think for starting from the end of October, there may be several issues we can focus on. First of all, we will have in Hong Kong, we will have the policy address. I think the Hong Kong government will announce different measures to boost up the property market and the stock market. And also in China, we will have the Politburo meeting. Somehow they should focus on the economy as well. So I think after the past 2 weeks, which is a policy window period, I hope we can have more policy support from Hong Kong and government, which will somehow to help to improve the market sentiment.
And how much is this linked to the property market? Do we need to see stabilisation in the property market before we're going to see any sort of real rebound in the stock market?
Yeah, I think what we see is a really pressure on the property price, especially from people who are emigrating, and they are being forced to sell at a steep loss. And in some cases, somebody bought a property something like 15 years ago and still suffer a loss when they sold out. And so there's really no optimism. It's only all gloom and doom in the property market now. And I think it really is the right time for the government to relax those really strict rules on buying properties, like cutting the 15% tax on the non-residents, and then company purchases, some things like that.
I think compared with the residential market, commercial property, I think is even
worse.
Yeah, even worse. Yeah. So I think that in the policy address, there should be some measure to be announced.
And we're seeing here in Hong Kong, aren't we? The government's just not selling enough land. It's only done, I think, about 18% of its annual budget so far. So which is going to have an impact on tax revenues here.
Yeah, they rather not sell at a bargain price. They don't want to benefit the developers.
But how are they going to raise money? I mean, this is a major source of revenue for the Hong Kong government, isn't it?
They have to sell more green bonds and silver bonds.
So that's why they're not willing to cut the stamp duty.
Now, what do you make of this report that the Hong Kong government is pushing for the Hong Kong Stock Exchange to remain open during typhoons? The task force has been told to look at this as a matter of urgency. You both work for brokers. Do you support that idea or not?
I don't support it.
No.
Like look at the black rain that we had 2 weeks ago. If you had to go to work, it was just pandemonium. And
dangerous.
Yeah, extremely dangerous. The entire city's been flooded. How can you get to work?
So I think, especially for small and medium brokerage firms, they are just not ready for the infrastructure or the manpower to handle in such a severe weather situation to provide the service. So that is the first point. The second point is, seems that it's not the top priority issue which Hong Kong stock market facing. So you are not targeting the most important part, but anyway, so we are not supporting this issue.
Yeah, so really, as you're saying, it's small brokers are hit much harder by this measure, aren't they? Where they're going to struggle.
We have so few people, we cannot. We just cannot cope with natural disasters like this.
It's also at odds, really, with what the government and the observatory says, which is to stay home, stay safe, except the stock exchange will then be saying, go out and try and get to work. It's slightly odd, isn't it?
That's right.
So what do we need to do to try and boost the volumes here on the stock market then? What's this task force got to look at?
Well, one thing we can look at is to introduce a market maker system for the small cap stocks. I think if you look at the small cap stocks, I think 99% of them are dead. They have no trading, no business whatsoever. And I think you should introduce a disciplined and regulated market maker system to maintain the liquidity in the market. Right now, for the small cap stocks, the problem is there's no liquidity whatsoever.
So the market makers will provide that liquidity and try and boost some overall sort of volumes, because the volumes are pretty dire at the moment,
that's
aren't they?
right.
Yeah, so I think no single measure can solve the problem, but many things we can do. For example, revamp the GEM bond, invite more good company to Hong Kong IPO, cutting the stamp duties or reduce the stamp duty. Many things we can do, but the committee already having meetings for 2 or 3 weeks, but nothing announced. So I personally hope in the policy address there will be good news for Hong Kong investors.
And let me just finally ask you about the Hong Kong PMI. It fell slightly, 49.6 at the moment, just below the 50 level, isn't it? So our private sector's contracting for the third month. Not a disaster, but still, the overall environment just seems to be gloomy at the moment. Are you sensing that?
Yeah, September we have a number 10 typhoon and black rain. I think we can blame on that.
Right.
And I think in October it should be better because there are more tourists from China. The streets are really crowded in Causeway Bay, Mong Kok, and Tsim Sha Tsui. So I'm more hopeful for October.
Yeah, I agree because it seems that China economy is starting to stabilize, and Hong Kong government already hold a lot of parties or functions. So there should be some improvement in the fourth quarter for Hong Kong.
Well, we're still seeing this trend, though, of we've had mainland tourists coming, but Hong Kong people going over the border
Yeah,
to the mainland
two to one.
instead. So, and they seem to be leaving at a faster rate than people are coming in, which is sort of still not helping our consumer spending levels, is it?
That's
really?
right. We should impose an exit tax. Everybody pays $100 going to some
Oh my goodness! Yeah. And what about the Night Vibes campaign? Is that helping? Are you seeing any improvements as a result of that?
Well, if you go to Wan Chai and Western and Tsim Sha Tsui, I think they did a good job. I think there are people there and then they're spending. I think they should keep it on.
Yeah, but yes, I agree with Francis. Whether the impact can be long-lasting will be the key.
Okay. Well, look, have a great weekend. Let's
Yep.
hope it's not too wet and windy this weekend. Thank you both very much for
Thank you.
coming
Thank
in and helping to keep things open here in Hong Kong. That was Kenny Wen, Head of Investment Strategy at KGI Asia, and Francis Lun, who is the CEO of Securities.
Peter Lewis's Money Talk.
I'm joined now by Tony Nash, founder of Complete Intelligence over in the USA. Morning, Tony.
Good morning, Peter.
Now, it's been an extraordinary week, hasn't it, in the House of Representatives? The Republican Party have kicked out their own speaker for the first time ever, I think, in history. That's happened, isn't it? So we're really in pretty much uncharted territory now. What happens next?
There's a lot that can happen next. There are a number of people who are up for speaker. One is former President Trump. I think he's kind of taking all the air out of the room right now.
Is that serious? Is that serious? The idea that he could be speaker?
Yeah, I think it's possible. I don't think it's probable, but I think it's possible. I think people are pushing it simply because it's something unconventional. Look, Americans are really tired of politics right now. Really tired. And, it looks kind of like a circus from overseas. Here, it's kind of a shoulder shrug, It's like, okay, now what are they doing, right? And so, I think people are just tired of business as usual, and they're tired of seeing a lot of money go to the federal government. They're tired of seeing the money that they send there. They're tired of seeing people like Dianne Feinstein, who just passed away this week, have a job that pays $140,000 a year, yet she retires having $110 million net worth. Okay. So Americans are tired of seeing this. And so I'm not in any way advocating Trump as Speaker of the House. I'm just trying to help people understand why Americans are even entertaining some of this stuff. Americans are tired of paying in. They're tired of seeing their politicians retire as, multi-millionaires after spending time in politics, this sort of thing. And so they're really looking for something different. They're looking for a generational change. Is Trump that generational change? He's not, but he's different. And so I think the people in the House of Representatives right now who are really interested in some sort of change are looking for, there was a motion today to set term limits so people can't serve longer than 12 years, to say that people, while they're in the House, they can't trade stocks, these sorts of things. And, we've had people like my own representative in Texas, his name is Dan Crenshaw. He was a regular guy when he became a representative. When he started in the House of Representatives, he started miraculously trading stocks, and now he's a multimillionaire, okay, while he's in that. So, again, there is a level of frustration that Americans have in politics, and that's part of the reason some of these characters like Donald Trump come into the fold as possible nominees for the House. Can they do it legally? Yeah. I mean, you don't necessarily have to be an elected official to become Speaker of the House.
But Is there a worry, though, that in trying to get something different, people are also turning to extremists? Because, some of these people that are pretty extreme, aren't they?
Yeah, that's why I don't think Trump will get it. Okay. People like Jim Jordan, who's been in the House for a long time, he's likely to get it. Or Steve Scalise, who's been in the House for a long time. Steve Scalise is famous because he was actually shot by a Democrat partisan when he was playing softball in a park in D.C. 10 years ago or something. So he's the majority leader in the House right now. And so I think it's really between him and Jim Jordan as to who's really going to get it. But I think when people overseas hear about this, they hear about Donald Trump and they hear about he might be Speaker of the House. There has to be this understanding that Americans are just incredibly frustrated with politics in America. And the partisanship and the media kind of blowing everything up into a huge scandal or huge, pearl clutching incident or something, and it's just not. It's politics as usual. It's drama as usual in D.C. Is the government going to shut down? Nobody really thought the government was going to shut down, right? Last week, right? This was just a story from last week. Weeks of drama leading up to will the government shut down? And at the end of the day, surprising no one, the government decided to fund itself, right? So nobody cares, right? I mean, these things come out and they're hyped and they're big stories. But at the end of the day, most Americans look at this stuff and just shrug their shoulders and go, well, it's those guys in D.C. They're doing what they do.
Are they? Has all of this though increased the chances now of a government shutdown? Because it seems that it's going to be really hard for whoever leads the Republicans to be able to work under any circumstances with the Democrats in the House and get anything done, doesn't it? It seems to increase the possibility that we can actually get a shutdown.
I don't think so. I think that the government, the representatives in government, will find a way to make us think that there will be a shutdown, and there may be a very short-term shutdown. But this is all theatrics. Again, as a political observer, all my life in the U.S. And for most of my life, I was outside of the U.S. observing U.S. politics. Living in Asia for a long time, living in Europe for a few years, and this is theatrics. The government isn't really going to shut down. There isn't really going to be reform. These things that most Americans are shocked that we pay so much for, it's not going to change. So will the government shut down? Maybe, but it's not going to be for very long. Are there going to be dramatic changes in spending by the U.S. government? Highly unlikely. So all of the suspense around government shutdown and gridlock and all this other stuff, it's drama. It's made for TV drama. But these guys are friends and they golf together and they go to the club together and they do all sorts of stuff together, regardless of partisan differences. And so, they're going to get it done. So whoever is Speaker of the House is going to do it. If Trump gets, if Trump is kind of voted in as Speaker of the House, he will turn it into a presidential campaign post. And the House probably won't get much done for the next year, which, again, most Americans are probably okay with that. Because, again, most Americans are very tired. It's just the eye-rolling nature of what happens in D.C. It's craziness. And so do they want to see the drama of Donald Trump as Speaker of the House? No. Very few people want to see that. But if it did bring people to really question and expose things that are happening in D.C., overspending and corruption and all this other stuff, I think over time people would probably be okay with it. But when you look back at Donald Trump's presidency, what did he really do that was remarkable? He did a few things, but you can't look back at it and say, oh, wow, that was an amazing presidency. He didn't do all the things he said he was going to do, right? It's like looking back at the Biden presidency, unremarkable, right? Both of them are unremarkable. So, I don't necessarily think Trump would get amazing thing done as Speaker of the House. So I think it'll be Jim Jordan or it'll be Steve Scalise who ends up being Speaker.
Okay, now presumably one of the things that's going to be very much in focus is debt, isn't it? The amount of government debt. And in particular with what's going on in the bond markets recently, we've seen the 10-year yield jump 60 basis points in the space of about a week, which is a pretty extreme move for the bond markets. What's causing these gyrations and these yields to shoot up to what a multi-year highs, 16-year highs in the case of the 10-year?
Good news is bad news, right? So we're in a place where when people hear that we're not going to have a recession and that job growth is strong and other things, that's actually bad news, meaning interest rates jump on that because there is an expectation that if hiring continues to be strong, if the job markets continue to be strong, then the Fed is going to have to continue to raise interest rates, right? And so if we have strong payrolls numbers and let's say we continue to have strong, say, real estate numbers and other things, then the bond markets look at that as the Fed not raising interest rates enough. And so we had a strong jobs report a couple days ago, and that caused interest rates to spike because people looked at it and said, "Oh gosh, okay, the market is still, or the job market is still very, very strong. That means spending is going to continue, and so that means the Fed's going to continue raising rates, and they're not going to just do 25. There's going to be 2 or 3 or whatever more rate hikes, right?" Again, that's possible, but when you look at say consumer spending, it did dial down a little bit in September. And some of these other indicators have dialed down a little bit in September. So I think we're in that part of the cycle where, people are kind of talking in both ways. Growth is tempering down. Oh no, it's strong growth. Oh no, it's not as bad as you think, or whatever, right? I mean, they're depending on the day, the market is trying to find the levels that it should trade at, and that's normal. In this part of the cycle, people trying to find, are we in a new bull market or is this a longer bear market? We're at that part of the cycle where people are trying to figure it out. So this is what we saw in bond markets on Thursday are not, it's not the end of that volatility, right? We're going to have volatility for several months until we figure out what the direction is, until we have a clear idea from the Fed, until we have a clear idea from, say, the jobs market, what's happening, until we have a clear idea in terms of wages, what's happening. And so I think what we've seen, particularly in crude markets over the past couple of days, has really helped because when you look at crude, you're not only looking at the crude prices, you're looking at the expected primary and secondary impacts of inflation, right? Not just crude, but what goes into, say, gasoline, what goes into plastics, so, even tertiary impacts of inflation, right? So when crude prices fall, that helps a lot of the economy to have lower prices, hopefully. And so, go ahead.
Are these yields at these types of levels, have they now actually increased the chances of the US economy going into recession? Because at the beginning of the year, people were predicting a recession, but were simply wrong. The economy held up much better than people thought. The jobs market has held up much better than people thought. But now we have yields at, interest rates at restrictive levels, yields moving higher. Are the chances of a recession, ironically, now increasing?
Well, it's the recession is that interesting kind of economist dilemma, right? Last year, people said it was going to be in the first half of 23. Then we got in the first half of 23. Then they said it's in the back half of 23. Now people are saying there will be a recession in the first half of 24. So we're always kind of chasing our tails on that, right? With these types of things, I like to talk to people in the markets and on the street. So I was talking to a mortgage broker here in the U.S. yesterday, and I said, "Hey, how much have things slowed down? Have things slowed down a lot?" They said, yes, things have slowed down a lot. The housing market in the U.S. right now, according to this person, is mostly cash purchases. The homes that are being bought are largely not done through mortgages because mortgage rates are so high. Okay, so that's what the Fed wants. They want the number of transactions and the nominal rate of those transactions to slow down. They want the prices to slow down. If people are paying cash, then they're probably buying a higher end property or something like that, right? But the legs are coming out from underneath the mortgage market, and that's exactly what the Fed has wanted to do. Okay, so these people who own 2 or 3 houses and have Airbnbs and rental houses and stuff, they're not able to rent those out as much. they won't be able to afford the mortgages on multiple houses. So they'll be foreclosed on, or they'll sell at a lower price. And what ultimately the Fed wants is they want those people who own 3, 4, 5 Airbnbs and rent houses to have to sell at a lower price because it brings the froth out of the real estate market. So do these higher rates mean we will have a recession? Maybe. It really all depends on where people keep their wealth and where that employment is. But what's more likely to happen, and I know this isn't really a mainstream view, but it's actually possible that we have, disinflation next year. And so what that means is the margins that companies get are smaller. And if the margins are smaller, then the valuations for those companies will be smaller. And if the valuations are smaller, then we'll see a market pullback.
Right.
Okay. So, unless those valuation multiples, go up for some reason, right? But those valuation multiples wouldn't go up in a higher interest rate environment. Those valuation multiples would only go up if we saw a strong pullback in interest rates. And so if we are truly in this higher for longer environment, which I believe we are, if we're in that environment and we have pullback in margins and disinflation, then we'll necessarily have to see a pullback in equity markets because valuations will pull back.
Okay. Well, Tony, look, thank you very much. It's always good to hear your thoughts. That's Tony Nash, who is founder of Complete Intelligence over in Texas in the United States.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then, Alex Wong, Director at Alex KY Wong Asset Management, and Frederick Chu, Managing Director at Magnum Research. And providing a view from mainland China will be Brock Silvers, CIO at Kion Capital. Have a great weekend.
Money Talk